Now, I guarantee that many of you have heard from your broker, the media, whomever place that selling naked puts is risky and don't ever do them because you can blow up your whole account and your house. And in this slide and the next one, I hope to change your belief system and show you how that is complete nonsense if you know what you're doing. And this, when you complete our option strategy course, you're going to see why selling spreads, call spreads and put spreads around the pattern and volatility provide phenomenal opportunity every single day. Recall that in the other slide, when you buy a put option, you have the right but not the obligation to sell stock. Now I want you to flip your thinking cap around. We are now going to take the other side of that put buyer's position. We are going to sell that put to them. What does that obligate us to do? We're going to have an obligation to buy the stock at the strike price we agreed on or before the expiration date. Let's continue to see what that means to us. Master Trader's strategy is to do this, sell the strike price below support where we believe the option is going to expire worthless. In that situation, the money that goes into our pocket or brokerage account is our maximum gain. What's our maximum loss? Well, it's whatever strike price I agreed to buy that stock minus the money that already went into my brokerage account. So that might sound like a massive big number, but it's less risk by definition compared to somebody buying the stock. I'll show you an example. And so that's why when brokers say, oh, it's too risky, it just blows my mind that that's such a novice view. This is a win-win situation. We're keeping money as pure profit, or we are buying the same stock that they would allow us to pay retail for. We're getting it at a discount. So that just blows my mind that a brokerage would say, okay, you can buy IBM at $160, but we aren't going to let you sell a $150 put option for $3, in which case you were able to buy it at $147 if you signed. I'm buying it $13 cheaper and you're not letting me do that? It's beyond belief to me. Here's our friend Warren, one of the most successful investors of all time, Warren Buffett. He does this all the time. He brings in billions of dollars by doing exactly this. Money managers use it. Hedge funds use this. And we and our subscribers do this. It's an awesome way to generate monthly income on quality stocks. Excellent way to increase ROI in your IRA accounts. It is permitted in your IRA accounts. You just have to have the money set aside to pay for it if needed. Here's my put selling example. It's actually a put spread, but I'll explain that in a moment. So we start with the pattern. Uptrend, pulled back, and now it's in a sideways trend. Tried to break down there and failed. So I would never buy this stock, but it's a great bottoming pattern to make the following option trade. So we looked at this pattern and we are selling a $180 out of the money put. Out of the money means it's below where it's trading. So this kind of looks like $204. So that is $24 lower than where it's trading right now. So we are selling this put that gives somebody else the right to make us buy it at $180 on or before expiration. Our obligation is we will have to buy it at $180 on or before expiration. But we're okay with that. And so now let me explain what a bull put spread is. Instead of stopping there at selling the 180 put, we're going to buy a 170 put further down, which does two things for us. It increases our return on investment because we have less buying power being consumed. And secondly, it gives us disaster insurance if something crazy bad happens to Humana here. And it opens up one day at $100. Yes, we're going to take a $9,500 loss, but the person who bought it at $204 is going to take a $104,000 loss. So what did we get for selling this bull put spread? So we sold the 180 put, we bought the 170, that's called a bull put spread. $500 immediately went into our brokerage account. Provided it closes and expires above 180, then we have made 5.2% return on investment. How do I get that? $500 went into my account. Maximum loss is $9,500. The difference in strike prices less $500 went into my brokerage account, 5.2%. Worst case scenario, if you are assigned this, is that you own the stock at $179.50 a share, over $24 cheaper than where it's trading when you put the trade on. Some will make you believe that that is too risky. I think that's a preposterous view, and we make money doing these strategies every day, and our series is going to teach you exactly how to do the same thing. We have a whole module on trading news and gaps, and this gave us two tremendous opportunities that I want to review here with you as a further example of selling options, as an example of fading the news, and trading gaps and volatility. So there's a lot of stuff on this one slide. So hopefully you're learning a lot, because the purpose of this webinar is to introduce you to trading and explain our option series course. But hopefully you're walking away with a lot of knowledge. So at number one here, let's see what we did. Goldman Sachs added NVIDIA to a conviction buy list. That's after, you can count them, after a dozen upgrades. Now you're telling me to buy this? Sight unseen. If you just told me, hey Dan, Goldman upgraded this stock that's up a dozen days in a row, far from its rising 20-period moving average, and it's gapping up $5. Without me even looking at the chart, I would say short a 30-minute low. Or in my option lingo, because that's what I'd really be doing, because I pretty much only trade options for the last 20 years unless it's not optionable, or if the spreads are too wide because it's illiquid. You never want to trade illiquid options. So under 30-minute low, we shorted the out-of-the-money bear call spread. So this is the opposite of the prior example where we were calling a market bottom on the pattern, not market, stock bottoming pattern. This one we're calling a topping pattern. So we sold the out of the money $5 higher, way up here, $5 higher than 120. We bought our insurance policy at 140, put on a 10 lot. So if we sold a 10 lot of this bear call spread, $2,140 would go into our brokerage account, and when it expired worthless, 16.6% ROI. This is the implied volatility rank. I mentioned to you that we use volatility for different strategies. When volatility is high, it's time to sell spreads. You do not buy options when volatility is this high. So as the stock was rising, volatility was rising also. Typically, volatility rises in fear and in panic, but it also rises on greed, as you see in this example. Example number 2. Volatility remained high because of earnings. So it's at major resistance on the daily chart. It had a bullish gap up over this red bar. So that's why we wait 30 minutes. It could have been a gap and go. It could have kept going from here, but it didn't. It quickly was sold into and just got slammed back down. So we sold a 130, 140 bear call spread for $1. That's $1,000 on a 10 lot, 11.1% ROI.